What's up everyone, Kenji here, and in this video I thought I'd talk about the stock market. So if you read or watch the news, odds are you've come across all kinds of headlines about the stock market, from tickers to buy and sell alerts to complex charts, all of which make the stock market seem like a daunting place. So in this video I thought I'd do my best to try and explain it. But before we can understand what the stock market is, we first need to understand what a stock even is. In short, a stock, which is also known as a share, represents ownership in a company. So if you buy shares in Apple, that means you're part owner of Apple. So for instance, if Apple's got 100 shares and you buy one of them, that means you own 1% of Apple, right? Now, in reality, Apple's got billions of shares. Now, if you want to be precise about it, it's 16.5 billion shares outstanding, meaning shares owned by investors. And you're probably wondering, how do you actually make money with shares? And there's actually two main ways. First one has to do with capital gains, which is essentially all about the share price going up over time. So if you bought Apple shares around September 2020, when the share price was approximately $110, and you decide to sell your shares today, where it's trading at around $150, then you'd have capital gains of around $40. So that's one way that they can make money. And the second one has to do with dividends. See, sometimes companies make a profit, and when they do so, they can decide to distribute some of those profits out to their shareholders. That's what's known as a dividend. Now, not all companies do this. Primarily, first reason is because sometimes they decide to reinvest in the company. So instead of giving it out to their shareholders, they might buy a new factory or something like that. And the second reason is that sometimes they just don't make a profit, right? So there's actually nothing for them to distribute. In the case of Apple, for instance, they pay a quarterly dividend of 22 cents per share, so 88 cents annualized. And sure, it may not sound like much, right? But you gotta keep in mind that they have 16.5 billion shares outstanding, so that means that they gotta pay out 88 cents to each of those. And at this point, you're probably wondering, why do companies want to sell stock? At the end of the day, if you sell stock, that means that you're giving up ownership in your company, right? And that's absolutely true, but the reason they want to sell stock is because they need money to continue growing. And you're probably wondering, well, why don't they just go to the bank like I might if I want to buy a car, for instance, just get a loan from them? And the reason they don't is that oftentimes it's too expensive for them to get a loan, or the bank just doesn't let them because they're seen as too risky, right? If they're growing too quickly, the bank usually decides not to lend out to them just in case something bad might happen. And let's take this back to Apple's early days in the garage. So they're rapidly expanding and they decide to go to the bank to ask them for a loan. But the bank decides not to give them a loan because they see them as too risky. So instead they go for what's known as an IPO, which stands for an initial public offering. This is basically the first time that the company sells its shares to the public markets. Prior to that, it was privately owned, meaning that probably only the founders had shares in the company, but now anybody can buy shares of them. Now, once the stock is sold publicly, that means that Apple gets all the money they needed to continue growing, but at the same time, they give up some ownership in the company. Now, it all sounds good up till there, but you gotta keep in mind that the Apple founders, Steve Jobs and Steve Wozniak, no longer own Apple fully, right? Now, they're shareholders, meaning that they're not their own bosses anymore, instead the shareholders are. So if the shareholders are not happy with Apple's performance, they can decide to fire them if they want to. That's actually exactly what happened to Steve Jobs. He got fired from Apple, the company he founded himself. So going public is really a double-edged sword. Now, he did get rehired by Apple later on down the line, but that's sort of besides the point. Alright, so we now know that companies want to sell stock to raise money. But where do they do that? Enter the stock market. And there's stock markets all around the world, but the most famous one is probably the New York Stock Exchange. And yes, I made sure to visit it while I was working in New York. But there's many other stock exchanges out there. In the US, there's also the Nasdaq. In China, there's the Shanghai Stock Exchange, while in the UK, there's the London Stock Exchange. These places used to be the ones that you'd see people screaming and running around the floor, but nowadays it's more of a quiet place, primarily because computers are doing the work for them. And at this point, you're probably wondering, what about the S&P 500? I hear about them all the time. But the reality is that they're not a stock exchange, instead they're an index, so their goal is to replicate the performance of a set number of companies. In the case of the S&P 500, it's the 500 biggest companies in the US that they try to replicate. So if you put money in the S&P 500, you're essentially investing in all 500 companies with weights assigned based on the size of the companies. So the biggest one now is Apple, so if you put $1,000 in the S&P 500, 6% of that will go to Apple, 5.9% into Microsoft, and so on. And if Microsoft got bigger than Apple next year because their share price went up by more, then the weighting would change, right? And you're probably wondering, why would you invest in 500 different companies when you can just invest in one, like say your favorite one? Let's say that's Apple, for instance. And the reason is that investors in this case, consider investing in one company as something quite risky. So for instance, if something happens to Apple's CEO that share price will go down. If Apple gets sued, maybe that share price will go down as well. Instead, if you own 500 different companies, even if Apple were to go down, the other 499 will hopefully be doing well. So that's why people decide to diversify and own something like an index. And there's many other big indexes around the world, like the Nikkei 225 in Japan or the FTSE 100 in the UK. Alright, so we now know what a stock is and a basic definition of the stock market. But what makes the share price actually go up or down? In short, it's all about supply and demand, right? For every trade, there has to be one person that's willing to buy and one person that's willing to sell. So if people aren't interested in a particular stock, that means that there's going to be more sellers than buyers, and as a result, the share price is going to go down. On the other hand, if people are very interested, so there's a lot of willing buyers, that means that the share price is going to go up. But what drives the interest in a share or the lack of interest in it? And it's really down to two main reasons. The first one has to do with the core business. So in the case of Apple, let's say they create a new iPhone which is selling a lot, and as a result the profits are going up. So investors are going to get really excited by that and they're going to want to buy that share. Now, to measure things like a company's profitability, investors are actually looking for all kinds of metrics like the PE ratio, which is probably the most famous one out there. The PB ratio is another one. And using these metrics and comparing them to other competitors, they're able to tell whether they should buy, hold, or sell an Apple share. The other main driver of interest has to do with stories. In the case of Apple, for instance, back when it was Steve Jobs, he was a very charismatic man, and people really believed in his ideas. Even if at the beginning sales and profits were not quite there yet, they still bought into his grand vision. On the flip side, there's also negative stories like that of Deutsche Bank, Germany's biggest bank, which back in 2007 admitted it was spying on its management team and some of its shareholders because the bank was scared they would reveal some secrets about them. For that reason and many other ones, back in 2007 the share price plummeted. Alright, so you now understand why prices change, and you're probably wondering, how can you make some money for yourself? Well, there's two major investing strategies: fundamental analysis and technical analysis. When it comes to fundamental analysis, it's all about doing extensive research on a company. So looking at things like their financials, so their balance sheet, their income statement, their cash flows, looking at the industry growth, and so on and so forth, and based on that, be able to predict a share price in the future. Now, the master of this is Warren Buffett, and that's basically how he's made all his billions, by investing using fundamental analysis. On the other hand, there's technical analysis, and this is all about looking at statistical trends. So looking at the big fancy charts like these ones to predict trends. They don't look at the company's internal operations at all, so they don't look for things like sales figures, profits, or other things like that. Instead, they just focus on identifying patterns. So they expect history to repeat itself, essentially. If back in the day the share price went down 3 times and after the third the share price suddenly went up, they'll be looking for that same trend, and if it does happen, when it's at the very bottom, they'll buy the shares and hopefully it'll go back up. Now, I just made that theory up completely, so don't use it in practice, but I think you get the idea. And there's a huge debate in the finance community as to which of the two methods is better. That's a huge argument, and I'm not really gonna get into that. But to do these investments, you actually need what's known as a broker, which is essentially an intermediary between you, the investor, and the stock exchange. So for instance, if you want to buy a share of Apple, say, you actually need to go through a broker. And some of the more common or well-known brokers out there are Robinhood, you've probably heard of it, Charles Schwab, as well as Fidelity. As for the fees for each trade, nowadays most brokers don't charge a fee at all, but there's still some that charge anywhere from $5 to $10 or something like that. But if you're interested in getting into investing, I do suggest you check out this other video that I made. I'll leave it somewhere linked up here. So what I've covered so far hopefully gave you a better idea of the stock market. If you have any future video ideas, do let me know down in the comments. Also, I'm constantly looking for feedback, so if you feel like I'm not doing the explaining very well or the editing very well, do let me know in the comments. I'm always happy to see where I can improve. That's all for this one, and I'll hopefully catch you guys in the next one.